So let's take a look as we start the new year. It's so important that you're running this as a business and you've developed a craft and you have an intentional plan that you're carrying out month in and month out for consistent income. Consistent income just won't come. If you're trying to make $2,000 a month or 10 grand a month, it's not going to come, right? Unless there's a consistent plan. Everything can't be, what do I think Costco's doing today? What do I think the market's going? That's a tough game to turn a business into. And so the first course that we're going to be starting this year, and I'm going to talk a little bit about some of the things today. The first course we're going to be teaching this year, and I try to do more of a portfolio class beginning of the year, because if you're not running it like a business, there's a really good chance at the end of the year you're not going to be up, right? If you're just kind of winging it, and a structured business. So the new class, which will be starting January 9th, will be trading your options portfolio profitably in your IRA account in 2020. And so Mark Fenton and I, we did something like this last year. We're going to tweak it and do it a little bit different this year. Plus, we're totally different market conditions. When Mark and I were teaching this portfolio class to start the year in 2019, what was the market like at the beginning of January 2019? Anybody remember? What was the market like end of December? End of December 2018, beginning of 2019. We're in the midst of a 20% correction, right? I mean, it was nasty, and even starting the new year, so we were in a high volatility environment, and so Mark and I kind of hopefully helped people kind of navigate through that, right? And what are we going to do in that period? Well, now we have just the opposite, right? Now we're at record highs. Volatility is much lower relatively than it was at the end of the year last year. And now people are worried about, we need a healthy correction. Hey, but it could go up. What do we do? And to have an intentional plan where you're intentionally putting capital to work, it brings a lot of anxiety. So we're going to come in and we're going to kind of have like I'm going to use a $50,000 portfolio for the class. I'm going to trade it live and show you exactly. So you can see starting the new year, get you good habits, get you in a good consistency, how we're allocating the money based on volatilities and price levels and different things. What strategies are we picking? How we're coordinating this orchestra. And I think that'll be very helpful for you to start the new year and continue on, right? So, and whether you were successful last year or not, I think this will be a big benefit to you. And we don't know what it's going to, as we're doing this starting in January, Mark and I, we don't know what the market bodes, but we're going to be in there with both feet with a plan and implementing it. So I think that should be helpful to you. And it starts January 9th. We'll go Tuesdays and Thursdays at 1 Central, 2 Eastern. But we'll be starting on a Thursday and ending on a Tuesday. And we'll be covering, again, the nice thing is we're going to be very transparent. You're going to see exactly how we allocate the money, the few strategies we do, why we do it. So at the end of the 3 weeks, you'll have a decent idea how and why we're doing this. So I think that you'll be able to make at least an intelligent decision. Okay, here's what I'm going to do. So we're going to give a doable plan here. Other topics that we'll be covering during this time, obviously, risk management, adjustments, the different strategies, how they fit together, which ones we're picking, and many different topics there. But let's dig in here and get a taste of it today. Let me share my screen. Let's start with SPX. All right. So as you look at SPX, you're seeing a price chart there. What do we have up there? We have, and this is kind of when we're teaching a class in January, I'll be looking at the beginning of each class, what's going on in the market, what's how we're making our decision making, and you'll see it step by step. And then we'll be giving, based on that, this is what the strategies we'll be doing, this is how much capital we'll be putting, so you'll see a clear plan. But some of the things we look at, you can see right now, we've got a 200-day moving average. The 200-day moving average is around that 29.59. And then we have the 50-day moving average. Your 50-day moving average is, what is the 50-day? 50-day is around 30.45. So I think everybody would agree, right, that we're clearly in an uptrend. Yes? Would you guys agree? Would everybody agree we're in an uptrend? Yes? Some of you? Okay, pretty clear. But everybody's a little bit nervous, but we're in an uptrend. So, to give an example, like if we're allocating, let's say, $50,000 portfolio, this time last year, when the market was down 20%, in the long portfolio, which would be neutral to bullish, covered rights, cash secured put, type strategies, put credit spreads, we were about 60%. 60 to 70% of the capital in a 50 grand. Why? Because the market was down 20%. And especially in that long, in the investing part of your account, if you're looking longer term, you'd love the market to be down 20%, right? If you're taking a neutral to bullish perspective long term. But right now, in the long-term part of our portfolio, I might be at 20%, 20 to 25%. So more than half of what I was last year, 20 to 25% of 50 grand. So I would probably be utilizing, maybe $10,000 to $12,000. Why? So I would be doing these covered rights, as I talk about covered right alternatives, long diagonals, cash secured put alternatives, wide put credit spreads, different strategies like that. I would still be doing them, but less size, right? So for one example on the long portfolio, let's look at, I think the question to ask yourself is, what is a stock that you'd buy 100 shares in today and you'd hold for 3 years? Do you think it'd be higher? And those would be stocks that you do covered rights or covered right alternatives. Now, one of the strategies I would look at today would be more of a long diagonal, with the volatilities kind of low moving up. One of these type strategies that would benefit if the volatility went up. And so, like a long diagonal, let's just take a stock that, one that I might consider. How many people would mind? How many people would have no problem buying 100 shares of Costco, COST, and holding it for 3 years and thinking it'll be higher in 3 years? How many people would have no problem buying 100 shares of Costco? Anybody? Give me one person. Okay. Dennis and me. All right, would buy Costco. All right. And I guess, again, I'm trying to get at the mentality of what would be the vehicles you would pick in this part of the portfolio. So if I look at Costco, an example of a long diagonal, which is going to be a covered right alternative. And again, I'm just giving just a little bit of painting a little bit of a picture what this class will be like. But what's nice is we're showing you how to run a business, right? And we're doing it there, because I think that's the problem. People just, We're trying to get you out of the mentality that it's just, where do you think the market's going? I don't want to know where you guys think the market's going on a 2-week or 1-month basis. I don't think we can make a living off that, or myself. Agree? That's tough, right? But there's a place for that. So anyways, a long diagonal is simply, would look like this. Let's just piece one together. I'm going 31 days out to January 31. I'll just give an example. In Costco, it'd buy a diagonal, right? So I'm just buying a diagonal. I'll just show you a quick one, and then we'll move on. Let's say January. Oh, am I still in SPX? I'm sorry. I apologize. Thank you for letting me know. So if you look at Costco, thank you. You can see Costco is kind of range bound right now, but it's been moving up over the year. It's been range bound the last 4 months, right? Which you can make an argument it'd be good for income trading. But if I liked it over time, a long diagonal, which would be the equivalent of a covered right, I'd say buy a diagonal, which are going to be neutral to bullish trades, right? So this would be an example of one. And Costco's at 292.76. So if I sold like the 295 calls, excuse me, I sold, just give you an example, selling out of the money call, 295s, and then buy like an in the money call in an expiration maybe 30 to 60 days further out. So if I look at maybe even by the Feb 21s 52 days out. So I'm going to buy the Feb 21s, excuse me. I'm going to buy the Feb 21s and maybe buy the 275 calls. So you're buying more of an in the money call. And you can see that looks like a covered right, doesn't it? Except the difference is, and this is 10 contracts. A 10 contract covered right, the debit's around $15 and almost 80 cents. So let's say close to 16. So for 10 of these, it'd be 16 grand. You think about it, for 10 of these, right? It'd be about 16 grand. One of them would be 1,600. If you did one covered right in Costco, selling the Jan 31s, right? The Jan 31s in Costco are the 295 strike. Second here. Jan 31s. If we look at the 295 calls, they're trading at $4. So if you did one covered right today in Costco, you'd spend about $29,000 to buy the stock, less $3 in premium if you sell the out of the money 295 calls. So 29. So let's be friendly and cost you about $28,000, right? One long diagonal costs you $1,600. 10 of them, it costs you 16. So to basically get a very similar position, long diagonals are going to be, give you the opportunity to make maybe 6 to 12% in a month versus a covered right. You're lucky because of the high price of the stock to buy it. You're lucky if you can get near 1%, right? You're lucky, right? And so this is the type of structure we're going to talk about, and we'll give you, in fact, we're just finishing a class on this, but really the key of this class coming up is how to put all this together. As you're coming into the new year, you have a lot of concerns. We're going full throttle, right? We're jumping in, right? But we're doing it very considerate of what's going on. And hopefully, if you get a good start with us in January, it'll give you a good springboard to the rest of the year. So this would be a long diagonal strategy. I'm buying, I'm selling the Jan 31s and buying the Feb 21s that both would be of the year 2020, right? Because December's done here. So that's what I would be doing. Selling an option about 30 days out of the money, and buying something 30 to 60 to 90 days out. And the other thing is also to try to teach you, even though we're long-term, to start these long portfolio strategies that we're long-term bullish, each month as we put these on, you know, we may think, hey, I want a little more downside protection in Costco. Maybe I think the market will drag it down. Maybe I want to sell a different strike. Which strike would I sell? Would I want to sell it more at the money or in the money? So how to do all this stuff, right? The next thing is if we go to the, again, income part of the portfolio, those are the two biggest part of the portfolios we'll trade, the long portfolio and then the income. The income would be more, instead of the view of an investor, the view of looking at range-bound trades based on probability and decay and time decay and good risk management. That's it. So when we look at SPX right now, what I would be looking at today, maybe different when the class starts, but today with the VIX, you know, as we're near all-time highs, we're still 30 points, that's all, from the all-time highs. VIX is 15, right? Because what is VIX? VIX has gone up about 1.5 points in the last couple of days, right? So I would come at it just right now. I don't necessarily, you know, I would do maybe a shorter term short Vega trade. Maybe let's see. We look at let's see, January, let's see here. A week from this Friday would be Jan 10. I might even go 10 days out, right? Yeah, I could be wrong here. And well, we still have a plan, but how many people think that we have to correct as soon as the new year starts, right? How many people mean that we have to get this 6-7% correction out of the way right away? Anybody? Isn't that what everybody's kind of saying, right? Like clockwork, like a song, right? Rally into the new year, we start our correction in January. Does life work like that usually? Yes or no? Please say no. It could happen, but it doesn't usually. So if I'm looking at a week from Friday, a shorter term butterfly for my non-directional trade, and again, sometimes I do 40 days out, sometimes we'll do 10, and that's where we'll spend a lot of time during our portfolio class talking about duration and strategy, in which they can give you clear instructions on that. But I'm just going to, for this, I'll just sell an iron, it's going to be an iron butterfly. And what it is just an income producing strategy. And you start it out with, the foundation of it is you sell an at the money straddle. You're selling the options that have the most extrinsic value, which means the ones that'll decay the most, right? And let me just show you the structure of it. So I'm going to sell let's see, at the money would be, we're at 32.16, so close to 32.15. I'm going to sell the 32.15 call. I'm going to sell the 32.15 put. What is that called? Short straddle. I'm selling the options that have the most extrinsic value. So then against that, I want to buy a hedge, right? Because it would cost way too much capital to sell an at-the-money naked straddle. So for this trade 10 days out, I'll probably go up about 30 or 40 points. Let's go 35 points. So I'm going to buy, is my hedge, the 32.50s. I'll just leave it at 10, even though we do one, but I would just want to, let me just see if we put it at 1. So I buy my long call or protection 35 points up, and then go 35 points down in my put to 31.80, and then let's start. And there's my trade. That would be an iron butterfly. I'm just selling premium. I'm selling the options that are going to decay the most, the at the monies, and buying some options further out of the money that won't decay as much. And my delta, my position deltas are going to be about 6 deltas short for each one. So I try to get that closer to 0. And so I'll take my upper strike long call and come down like 10 points to 32.40. And it will make my position deltas pretty close to 0, right? And you can see now they're broken wing. What does that mean, broken wing? If I'm selling the 32.15 call, my hedge for my out of the money long calls to 32.40, because I brought it down 10 points. The call credit spread, a part of the iron butterfly, is 25 wide. The put side is 35 wide. And so to get my position deltas neutral, there's an unbalance, much less risk on the upside than the downside, but the deltas are close to 0. Your theta is about 16 for the position. And again, these are just the income or range bound part of the portfolio. Right now, I'd be at 50%, right? We have 50% of our 50 grand of capital in these range bound trades. And we have quite a few, maybe 4 or 5 indicators we're looking at. We're not naive about this, but you can't make a living if every day you're getting up, I can't trade, what if this? I can't trade, we're going to have a correction. How many people went through the entire 2019 and didn't trade much or traded from the short side looking for a correction? You'll be out of money before we go down. And to me is you trade what you see, right? We're clearly, and we'll show you more next week, but, in the correction last year, real early on in it, we got plenty of signals. Most of the corrections, we're going to get good signals. We can show you how we see that, but you keep trading, right? Right now, we're in an uptrend. And until we see something, right? Something in the ATR or the VIX, some of our indicators, we're going ahead, right? We can react. It's like if you're driving in the weather in Chicago and you say, when am I going to pull over to the side of the road when I have 10 inches of, when I have 6, 7 inches of snow? Well, if you're sane, well, there's 6 or 7 inches of snow. Yeah. And we'll know, right? We'll look at some of these different indicators. Anyways, so that's just a little, I'm excited about this emphasis on the portfolio beginning of the year because I want to get you guys off to the trading and not speculating for the whole year and playing fearfully. And Robert will show you why, in the class more why we would do butterflies over calendars, but in this particular case, not only do I not think that we're going to have a big, necessarily the correction at the beginning of the year, that's why I went shorter duration, but with the volatilities here, I think, because the volatilities have gone up 1.5 to 2 points over the last 2-3 days at the 15, I'd rather do a butterfly than a calendar at these levels. If we were a little lower, I would. So we'll give you in the class clear indicators when you would do certain strategies versus the other, so it's not a mystical experience as you're putting this portfolio together. We've been doing this for a while. So anyways, so folks, I just want to leave you, have a great new year. Our new year in England will hit before yours will. And we'll be seeing you a week from this coming Thursday will be the start of the class, and I really want to get you started the right way. And there'll be information on our website. You can sign up. So Happy New Year, everybody. We will see you Thursday, January 9th for the portfolio class, Trading Your Options Portfolio Profitably in your IRA in 2020. Have a great year, everybody, and we'll see you soon. Thank you.